Welcome to Security Token Stories, brought to you by Security Token Academy, the leading educational platform dedicated to covering and facilitating the security token industry. I'm Derek Edward Schloss, Director of Strategy at Security Token Academy. Coming up on today's podcast, we have Steve McKeon, partner at Collab Crypto, a venture fund investing in blockchain-based financial infrastructure with an eye towards the future of our financial markets. Steve is also a finance professor at the University of Oregon and one of the leading thinkers in the security token space. In addition to his roles at Collaborative Fund and the University of Oregon, Steve is also the Chief Strategy Advisor at Security Token Academy. Steve, it's great to have you on Security Token Stories. This episode's going to be a fun one for me. As I mentioned in the intro, you're a professor at the U of O, but what the audience might not know is that way back in 2012, you also happened to be one of my professors at Oregon's MBA program. I think that may have been one of your first MBA finance classes.
That's right, yeah, and that was really an amazing class with you and Jonathan Evans and Matt Pinelli. There's lots of students I still keep in touch with from that class.
That's great. Why don't we start there? And maybe before we get into security tokens and your paper, the Security Token Thesis, we can hear a bit about your background in finance and then later in entrepreneurship, and finally your work leading up to blockchain and security tokens.
Sure. So, I started my career in entrepreneurship in Silicon Valley right during the height of the dot-com boom. I've always been in finance. I was a CFO for a while. And at some point decided maybe I'd like to try my hand at being a professor. Always really enjoyed research, trying to answer questions we didn't have answers to. And so went back to school, got a PhD, and then started here at Oregon in 2011. And shortly thereafter, 2012, is when I had my first MBA class, which you were part of course, as were Jonathan Evans and Eric Ringer. And Jonathan and Eric were working on a startup in the drone software space, which we eventually named Skyward. And so I co-founded that company with them, and that was a wild ride. And we raised a couple rounds of venture financing and eventually sold that business to Verizon. And so that kind of really dragged me back into emerging technology. And I became really interested in the intersection of technology and regulation, right? Because when we started the company, commercial drones were actually not legal to fly in the US. And so it was always a huge pain point, a lot of friction around raising investment in that environment. And so, I became interested in crypto while I was at Skyward or working with Skyward. But what I found was that I just didn't have time to really dive in. But when I left the board at Skyward in 2015 and dove in, was introduced very shortly thereafter to Chris Berniski, and Chris sort of dragged me down the rabbit hole. What I found is that a lot of the stuff I'd been thinking about for a long time, whether it be the intersection of regulation and technology or security issuance or valuation models, all of these were relevant to crypto as well. And so it really just fit like a glove, and I've been at it ever since.
Yeah, you've had a really interesting path, and this industry is lucky to have you. For those brand new to digital securities, let's start from the very beginning. What exactly is a security token? And in a few words, why might our private and public markets benefit from this new formatting of our global assets?
Sure. So the way I define it in the article is that a security token is just any representation of value on a blockchain that's subject to security laws. Now that's a really broad definition. A lot of different assets might fall into there. So you've got traditional assets like equity or debt or real estate, where if you represent a share of stock on chain, meaning like there's a token that represents a share of stock, that's definitely a security token, right? It's a financial security. If it's not on chain, this is just a different type of digital wrapper. It's still a security. Then I would say you have a whole different category of security tokens where they're sort of transient securities, right? So they raise capital, they want to build a network, and sort of pre-launch, the things that they sell are going to be securities. But eventually, if the network becomes sufficiently decentralized, and we don't really have a definition for that yet, but as a concept, If it becomes sufficiently decentralized, then it no longer is a security, right? And so Blockstack, for example, very recently was approved for Reg A+. UNOW and the props token was recently approved for Reg A+. Those are regulated as securities, but it's not impossible to think that someday those networks reach a point where they are no longer securities. And so some security tokens are going to be securities for the life cycle of the asset, whereas some of them are just going to be securities for a period of time.
Yeah, that's helpful in delineating between those two subcategories of security tokens, traditional securities and transient securities. So I think this is a good point to kind of start walking through the security token thesis. That paper you published in May of 2018, it seemed to unofficially kick off a lot of the excitement around security tokens in the industry. To recap, you argue that for a number of traditional assets, security tokens will simply dominate previous methods of reporting and trading ownership. And you listed out 8 killer features that formed what you described as the thesis of security tokens. This is one of the first episodes of the podcast. I thought it'd be great to sit down with you and walk through the thesis point by point.
Yeah, happy to do so.
You first start off with 24/7 markets. Can you walk us through how our markets may or may not be frustrated by limited trading times today?
Sure. So I guess the one thing I would preface this whole discussion with is that I listed these things out sort of in the order of things that I think are often cited as benefits, but really aren't maybe as important as some people think, down to towards the end, the features that I think are most important, which are mostly around interoperability and the design space for securities. So 24/7 markets was the very first one I listed. And it's because it is a feature that is potentially possible, right, by moving these assets on chain. It's frankly also possible without moving things on chain. Like NASDAQ or NYSE could be open 24/7, but they choose not to. So, the comparison I drew in the article was that if you want to trade a share of stock, you've got major US exchanges sort of open at 9:30 a.m., close at 4, only on weekdays. And if you want to trade Bitcoin, you jump on your Coinbase account, you can trade that 24/7, other than when they're maybe down for maintenance. And so that is a really big difference in the number of trading hours at which you can access the market. And I know there's a lot of people that would love to be able to trade stocks off hours. And the exchanges do have extended hours, so it does extend a bit beyond the 9:30 to 4, but pretty difficult on weekends unless you have an app that's going to take balance sheet risk by allowing you to execute that trade on the weekend. Like the markets are not open, right? So if you move things on chain, I think the big point was that the ethos in blockchain is generally around 24/7 trading. And so this is certainly not a feature that requires blockchain, but it is something that we often find in blockchain environments.
The second point of the thesis is fractionalization, or more specifically, the efficient fractional ownership of assets with potentially high unit costs. So I think the example you used is this idea of a Manhattan high-rise. And you've got a few options today that you spell out. The first is you can afford the Manhattan high-rise outright. You have a sufficient net worth to be able to invest in an expensive asset of that type. The second is you forego exposure entirely. Or third, you get exposure through an intermediary, like a publicly traded REIT, which is bundled in a portfolio of other buildings.
The concept that is interesting to me here is something that economists, financial economists in particular, call the market portfolio, right? So the market portfolio you could think of as having like a very small proportional piece of all the different assets in the world. And of course, like in real life, that's not feasible. But what is interesting is that we could use security tokens to get closer to that market portfolio. So the idea is, as you mentioned, if I want exposure to New York real estate, it's actually quite challenging to get that as an individual investor, right? As a retail investor, I should say. So I could purchase a portion of a REIT. So we do have fractional ownership, real estate investment trust, but usually those hold a big basket of assets, right? And also they're only in major markets. Like what if I live in Minneapolis, right? And I want exposure to the Minneapolis real estate market because someday I hope to buy a house. And if the prices go up, I want to participate in those gains. There probably isn't a REIT that just focus on Minneapolis residential real estate. And so the idea is that by wrapping these things in tokens, again, just a digital wrapper that makes it easier to represent, easier to trade, just reduces friction in the way this value moves around. The idea is that we could tokenize a lot more assets than what we observe in fractional platforms today. And so I think that's the general concept is, again, this is something we definitely can do without blockchain. But by using security tokens and reducing the friction around issuance and around trade, it makes it easier to expand fractional ownership to a substantially larger number of assets.
Yeah, framing this idea of fractionalization as getting closer to market portfolio has been helpful for me to understand this point. The third point in the security token thesis is rapid settlement. And maybe first we can talk about the difference between execution and settlement in our markets and why rapid settlement might be a feature worth exploring as this technology comes to bear.
Sure. So the point I draw here is that we can execute trades very quickly, right? So we've all read about high frequency traders. Like you could throw hundreds or thousands of trades a minute at these exchanges, and they can deal with that. But the settlement piece, where the money actually changes hands and the asset actually changes hands, takes a lot longer, right? So T+2 or T+1 is in days. And so moving a share of stock before it's actually in your account and the money is actually in the seller's account could take a couple days. Now, conceivably, moving these things to a blockchain could speed that up. Now, it's not nearly as easy as a Bitcoin, where I guess I should say it's not as easy as Bitcoin because there's a lot of different parties involved. There could be short interest on the asset. There's exchanges, there's custodians, there's market makers. So a lot of these are also involved in Bitcoin. But the point is that in order to actually speed these things up with blockchain, it's really key that it is interoperable, that the system is interoperable between all these different participants so that we can automate some of these settlement processes.
That's great. The fourth piece to the security token thesis is cost reduction throughout the life cycle of a security.
Cost reduction is a benefit that I think sometimes is overstated in the sense that, one of the big costs in issuing an asset is the advisory and literally just the marketing process, right? So, in a typical transaction, an investment bank, like in an IPO, an investment bank goes out and actually sells those securities to potential investors. And they charge a lot for doing so. Well, if you wrap it in a digital wrapper, it doesn't necessarily mean you don't have to sell it anymore, right? So you may still bear that marketing expense for the asset to actually get it from the issuer to the potential buyers. But it's also possible that new platforms will pop up that assist in doing some of that marketing that is traditionally fulfilled by investment banks. What I do think we can reduce a lot of is the sort of administrative work, right? So all of the reconciliation around the ledger, around which shareholders actually own the stock, lots of the costs around the legal work. I think a lot of that is going to be standardized in time. And so I think there are a lot of administrative costs that can get suppressed, but I do want to be clear that it's certainly not all the costs related to the issuance of an asset that are going to go away.
Definitely. And I think some of the early hiccups around cost reduction as it relates to security tokens is this is such a nascent space. And I think attorneys and firms are trying to wrap their heads around how this stuff will work throughout the life cycle. And with that learning comes additional time and cost. So what we're seeing in the early days is there's certainly not a cost reduction just quite yet, especially as it relates to the issuance of these tokens. But to your point, I think once you have these securities digitally wrapped and reconciled in real time by code, I think those lifecycle administrative costs will get mitigated quite a bit.
It's an interesting point because with regards to law firms, 20 years from now, all law firms are going to have technical staff that are competent in reviewing smart contracts, right? And of course, there's going to be tools that pop up to help them do so. But the idea is that a lot of this legal language is going to get embedded into the contract itself, into the asset itself, rather than sort of papered in the traditional way. And so we're going to see the legal profession be required to evolve right alongside that.
Do you think the future of the legal profession as it relates to securities laws and transaction of assets, there will be a leg up for attorneys that are taking the plunge now and learning to code and really understanding the space on a level that just hasn't been required by professional service providers in the past?
Absolutely, right. So, I mean, I think um, any law firm that's dealing with security issuance or contract law generally should be learning about smart contracts and about blockchain, because there's no question in my mind that we are going to see more and more contracts move this direction. Now, again, that doesn't mean attorneys are going away. There's still a lot of room for interpretation. There's still a lot of room for kind of determining what features should be in the smart contract. But I think, when you think about, often one attorney will draft something and then other attorneys will have to review it. I think some of that work is going to move to a more automated basis because a lot of what they're going to be reviewing is in code.
That's a great segue to the fifth point, which is automated compliance.
Yeah, so automated compliance is the idea that one of the big frictions with selling securities is literally just maintaining compliance with security laws. All right. And so that could be cross border, that could be internally. Like if you have to be an accredited investor, somebody's got to check that off. Somebody's got to make sure that KYC and AML laws are being followed. A lot of that right now is done with what we call walled gardens, right? So I get an account at E-Trade, you get an account at Merrill Lynch. Each of our respective brokers is making sure that we're okay. And then once they're sort of signed off, like now we're inside the walled garden and we can trade securities. But the idea, particularly with decentralized exchanges, is that we may not have those walled gardens. And so we want the contract to be able to do some of those checks directly. And so that's the concept of automated compliance, is that if we've registered with a regulator service, it can check off against that without requiring us to be inside a walled garden in order to trade. And that some of that is done automatically. And if something fails, right? So if I'm trying to sell you an asset and you're not an accredited investor and it's required for this asset, the protocol will stop the trade. I think that's the really key feature that frankly differentiates security tokens from a lot of other crypto assets, right? Like with Bitcoin, it's not a security. You're not going to have those checks. There's, once a trade is made, the trade goes through. There's not a regulator service that stops it necessarily. And so I think with securities, that is a feature that is required simply because of the nature of security laws.
Listening to you talk, I think one of the interesting things we're seeing right now is these two parallel compliance methods for securities. On one hand, we've got these traditional securities, let's call them paper or PDF-based, electronic in certain cases, which require more manual hands-on compliance checks. And on the other hand, we have these blockchain-based securities being created that have these compliance standards embedded within the protocols themselves, which is helping automate their compliance. Based on the efficiencies here and legal certainty that regulations are being followed, do you envision a future scenario where our regulators require the digitization of securities?
It's certainly not impossible, right? And so the example I draw is around Edgar, right? So if you go back into the mid 90s, just as the internet was essentially taking hold and becoming more ubiquitous, the SEC moved to all electronic filings, right? So as you mentioned, everything used to be on paper, then it became electronic, and the SEC required that so the dissemination of the information to investors was standardized. And so it's still very early days. I don't think you're going to see the SEC requiring securities to be on chain in the near future. But again, as the system starts to take hold and more investors are onboarded, it could be the case that they determine that this is something that actually increases transparency and increases various features of the regulatory environment that they desire. And so you could see some sort of decree where over a period of time, they phase in securities to be on chain to enable some sort of feature that is difficult to provide otherwise.
This next point of the security token thesis is one that gets quite a bit of highlighting from the early infrastructure builders and issuers that are jumping into the space. It's this idea of improved liquidity and market depth. I'm curious to hear your thoughts on this one.
Yeah, I mean, this was the first thing. I think this was the first benefit that really piqued my interest about security tokens. So there was actually an article about a year before this article called Traditional Asset Tokenization. And that was the first time I wrote about this idea. And, I'd recently participated in the Blockchain Capital BCAP offering. And, what I realized is because I've been around venture funds, I teach about venture capital and private equity at Oregon. One of the features is that you're often locked up for about 7 to 10 years, right? So once you commit to contribute the capital, it's deployed into illiquid assets. And so you really can't do a redemption feature. You have to wait until those firms grow up and some of them exit, and then you can return capital to the investor. But the whole idea, this was a quote attributed to Josh Stein from Harvard. He said, lock up the capital without locking up the investors. So the idea is that the fund shouldn't really care if those ownership claims trade around, right? So that the investors can get liquidity if they need it, as long as there's no redemptions on the fund itself. And so the way you enable that is with a secondary market. And you've got to standardize the claims on the fund. And so that's one of the things tokens can help with. And then at that point, and I believe they're now listed on Open Finance, you could go set up an account and you actually could sell some of those tokens if you felt like you wanted to get out of the position. Similarly, if you didn't participate in the initial raise, but you wanted to get into the fund, it allows you to do that as well. So it creates a market, like a secondary market, for claims on a particular asset, in this case, venture capital or private equity, that we really haven't seen a lot of. There are some secondary brokers for private equity among the big institutions, but we just really never have seen it at the retail level.
On this point, one of the other things I took away from your piece is that this idea of improved liquidity and market depth comes as a result of a lot of the other points you're making in your thesis, right? It's this idea that we can now easily fractionalize and divide these assets. We can use smart contracts in tandem with algorithmic market making to improve the speed at which these things move and travel. We're mitigating market segmentation globally by using consistent standards and potentially having markets that accommodate all time zones. And compliance can get baked in and helps facilitate these global markets through the reduction of process intermediaries and other types of friction. So it's almost as if this idea of liquidity is really as a result of a lot of these other benefits you're stating.
Absolutely.
Number 7 in the security token thesis, and I think we're getting into some really interesting stuff here. It's this idea that you call asset interoperability. You wrote that the arc of technological evolution bends towards interoperability, and interoperability is facilitated by standards. What did you mean by that? And why is interoperability empowered here by security tokens?
Yeah, so this is, I think, one of the key features, right? Because standards are something that I've always been fascinated with. I'm going to be writing more about standards in the future, I think, because I'm fascinated. How do they evolve? How are they adopted? Why is it that we all agree to do something the same way? And the answer usually is that there's more economic benefit to joining a particular set of standards rather than diverting and trying to create a different set of standards. So in the case of blockchain, often people point to ERC-20 as being sort of a seminal moment for capital formation through blockchain tokens. And what ERC20 did, just for those listeners that aren't familiar, that ERC20 is a standard on the Ethereum network. And what it did is it allows different wallets and different exchanges and different tokens, as long as they all adhere to this ERC20 standard, to be interoperable, which means if you have an ERC20 token, you can hold it in any wallet, you can trade it on any exchange, as long as they're supporting that technological standard. And so that's just, it's so important because we don't have that right now. And it's one of the things that creates, I hate to keep using the word friction, but it does create a lot of friction with moving assets around, right? So if you think about it, a lot of assets are literally on paper, like in a file cabinet somewhere. Some are electronic, but they're on PDFs. So I've done some real estate development with a group called Skyworks up in Portland. And to move people in and out of a limited partnership is actually quite costly because you have to repaper the whole deal. And so the idea is by creating this digital wrapper that is sort of standardized in terms of the way this value is going to move, that it moves on a certain set of crypto rails, it just is going to reduce all the cost associated and all the headache really associated with moving value from one individual to another or one organization to another. And so I actually think this is the most exciting part of security tokens, is this idea that if we can standardize the way ownership claims on assets are represented, whether that be real estate, whether it be debt, whether it be equity, whether it be native digital things like revenue share agreements on particular networks, if we can standardize all of those things to trade sort of in the same system, it makes life a lot easier. We can hold them in the same wallets. We can access them through the same interfaces. We can move them in the same ways. It's something we don't have right now, but I am hopeful that we have eventually. So I view the establishment of standards and the establishment of interoperability between different assets as being one of the key long-run goals for the space.
The eighth and final point of the security token thesis is this idea of an expanded design space for securities. You wrote, "The current stage of security tokens is analogous to broadcasting a radio program on television. We've only just begun to tap the expanded design space for securities that it facilitates, and we just don't know how it's going to evolve from where we stand today. It could be a huge canvas for creativity over the next decade for those involved."
Sure. So this is, I think, probably the piece of the thesis that allows for the most creativity and is sort of the most fun to think about, right? Because it's really bringing about the question, what is a security? What can we do with a security that we can't do now, right? Once we have programmability and we can embed logic directly into the security, what things can we do? So the example I provide is around the dawn of television and radio, right? So, when television first came about, the first thing we thought to do with it was to take radio shows and put them on screen, which was certainly an improvement, right? It was a more interesting experience for the viewer, which used to be the listener, because now they could see as well as hear. But ultimately, as we know, video content has evolved way past just putting radio shows on screen, right? We now have YouTube, we have video, user-generated content. We have all these things that were probably like impossible to imagine at the moment when television was invented. And I'm hopeful we see the same thing with securities. So initially, we'll probably just see securities as we understand them today move on-chain, sort of plain vanilla issuances, right? So instead of issuing a share of stock on paper, you issue it in the form of a token. And you get all the features we've just talked about for the last 15 minutes just by creating that new digital wrapper, right? It's easier to issue, it's easier to trade, it's easier to custody, and so on and so forth. But in the longer run, what you're also going to get is that the nature of the security itself. So, often if you dig down into the question of what is ownership, if I was to ask a student, like, what does it mean to own something? we have that conversation often in class, and what you drill down to at the end is it's a set of rights, right? So typically with a share of equity, it gives you cash flow rights. All right. So if the company issues a dividend, you get a portion of those. It gives you governance rights. So typically you get to vote on matters that come before shareholders. And you have the right to sell it, which is also sort of a cash flow right. That's about it, right? It doesn't give you the right of access. Like you can't, if you own a share of Microsoft, you can't waltz into Microsoft campus. You don't have, a variety of rights, but the ownership of a share of stock gives you specifically governance and cash flow rights. Now, if I own my house, I also have access rights. I can live in the house. And so you can drill most ownership claims down to a set of rights. And so the question is, what set of rights can be expanded by creating programmability? So maybe it is the case that if you have fractional ownership in a building, that you get some sort of access rights. Or if you have shares of stock in Chevron, that you get a discount on gasoline. So it's going to bring the capital markets and the product markets much closer together, because you're going to be able to interact between those two by being able to identify if your client is also an owner. And so that's a really exciting idea. I think it's a little further out. We've got to do, of course, a ton of work just around doing digital wrappers on things we understand. But I do think it's where the space is going long run.
Yeah, I totally agree. The unique innovations empowered here is certainly going to be something to follow. Another area I've been very interested in is this intersection between these digitally wrapped securities being referenced by decentralized finance or DeFi protocols. I know this is an area that you started to take a look at in your role at Collab Crypto. Maybe you can tell us a little bit about how you're seeing this intersection between security tokens and DeFi and some of the work that you're starting to do here.
Yeah, so we think that the ability to borrow against these assets could be one of the kind of killer use cases that drives mainstream adoption. And so the idea is we've invested in a protocol called Maker, which many of your listeners will be familiar with. And essentially you post collateral and then you can effectively take out a loan in a stable coin called DAI. And then you can do whatever you wish with that, right? Just like if you were to take out a mortgage on your house. So the idea is that as Maker moves to multi-collateral, which is on the roadmap, the idea is you could buy a piece of real estate, but then you could pledge it against that system and take out a loan, right? Which maybe covers a portion of the purchase. So it's like taking out leverage, which is a very common thing to do on real estate, right? Like very few people buy their first home without a mortgage. Like we're accustomed to taking out leverage on real estate assets. And so being able to do that with a protocol, we think is really interesting idea. And so we see a lot of intersection between DeFi and tokenized securities as the space develops, particularly around lending, but also around the way they trade, right? So you could see things like Uniswap and other sort of decentralized exchanges begin to facilitate transfers of these assets. And so we're excited about that combination for sure.
You're working on a new piece at Collaborative Fund called Consumable Digital Commodities. Can you walk us through your thinking behind the piece? And as an investor, your thesis around blockchain-based digital commodities as a potential investment category?
Yeah, so I guess this really grew out of a thought experiment we've been working on. Just in the sense that, we think a lot about markets, and our thesis in the crypto fund is largely around financial infrastructure. So one of the things we've been thinking about is what will assets look like in the future? So as I mentioned, the design space for securities might evolve because now we can put all these new features in them. But also, if you flip to a different asset class, which is commodities, we think that might evolve as well. And I guess the starting point is that a lot of times people think about Bitcoin as digital gold, so effectively a digital version of a commodity, something that functions primarily as a store of value. But if you think about the commodity market in general, you've got corn, you've got soy, you've got steel, you've got oil, you've got all these other commodities out there in traditional markets. And these are consumable commodities, right? And so, people buy corn, like there's a producer that grows corn, they sell it off to somebody that maybe turns it into cornflakes, and then eventually some consumer eats the cornflakes, and then the commodity is gone, right? So they're produced, they're typically transformed in some way, and then they're consumed. And then that's the end of the life cycle. So they're not meant as a store of value. They're meant to be part of the production and consumption process. And so we started thinking around, what does that mean in the new sort of digital economy, right? Because in the 20th century, companies used steel and they used fossil fuels like petroleum and coal to produce energy. Those are the things that were the inputs to production. So if you think about like a manufacturing plant for a car, right, or for a table, or sort of like any of the things we might purchase. Now in the 21st century, what we're seeing is that more and more products are strictly digital, right? So if you look at the biggest companies in the economy now, Google, Facebook, Microsoft, they're not using steel and they're not really using oil to produce their products. They're using data, right? And so there has to be a new era of digital commodities that grow up to serve the idea that we're now producing products with data rather than with some of these tangible goods. And so I think I'll post this article pretty soon, probably within the next week or two. But the idea is that there's a bunch of things you could think about. I mean, data needs to be stored, it needs to be processed, it needs to be transmitted. You could kind of think about like, what are all the needs around data, right? And then you try to think about like, well, are some of those things going to be commodities? Well, right now, like AWS and Dropbox and a variety of other providers, sort of centralized providers, mostly provide that data storage capacity, right, in the cloud. But to me, that's something that is eventually going to get commoditized, where we're going to differentiate mostly based on price. As long as they're all sort of reliable in terms of retrieval, there shouldn't be a lot of other things to differentiate on. And so we could see file storage becoming a commodity. Now, as an investor, when something's going to get commoditized, generally speaking, that's something you want to avoid, right? So that's something that you typically isn't attractive as an investment. Things that are more attractive as investments are things where there's a trusted brand, right? Where there's product differentiation so that you can be a price maker versus a price taker. When something gets commoditized, price usually drops down to kind of the cost of production and equilibrium. So I guess to summarize, as some of these things become commodities, what's now interesting in crypto is that we can invest in the markets where they might trade as opposed to the asset itself. So file storage is a great example. And we've recently completed an investment in Nebulous, which runs the SIA network. And the idea is that it brings the cost down over something like AWS by 10x, right? And so there's a massive price discrepancy between the centralized provider and the decentralized provider. And over time, as the good is viewed to be more and more homogeneous, those cost differences are going to matter. And so we're really excited about this concept of consumable digital commodities and are sort of actively looking for more investments around that thesis, because you could think of things like raw compute, you could think of like content delivery networks, you could think of connectivity. I mean, there's a variety of sort of digital goods and services that you could imagine becoming commoditized over time. And we think those are really interesting plays in terms of investing in the market where they'll trade.
That's fascinating. I'm excited to dig in more and continue to follow what Collaborative Fund is working on. I have to ask one final question. Let's do a thought experiment. The year is now 2035. The Security Token Thesis has played out just like you drew it up. What are some of the unique types of assets you're most looking forward to people having in their future portfolios?
Oh, that's a great question. I actually think the most interesting aspects in the long run are these native digital securities. I love the idea of traditional assets coming on chain because I think we do need better ways to manage and to trade equity and debt and real estate. But I'm also really curious to see, when you build a network and you can share the revenue with the users, right? So the idea of like, if you're generating content, right, and then somebody's paying you for that, and again, all the commodities that I sort of described earlier, I guess the things I'm most excited about are the things that we don't have today.
Right.
So it's really hard to predict exactly what those are going to be, but I think we're going to see all kinds of investable assets in the future that simply don't exist today. That 15 years down the road, the number of potential things that we can invest in is going to expand substantially, and so it's very hard for me to tell you what those things are today, but I can tell you that I think there are things we haven't seen yet.
Steve, that was a great answer. We're going to have to get you on the podcast again soon. This was a lot of fun.
Anytime. Thanks for having me, Derek.
That's it for this week's episode of Security Token Stories. For more Security Token content, visit us online at securitytokenacademy.com and subscribe to our newsletter, The Security Token Edge, which lands in your mailbox each weekend. You can also keep up with the latest security token news by following us on Twitter, Telegram, YouTube, Facebook, and Medium. Before we go, a big thank you to Security Token Academy's Platinum and Gold corporate members who make this podcast possible. You can learn more about Security Token Academy's corporate members at securitytokenacademy.com. I'm Derek Edward Schloss. From all of us here at Security Token Academy, thanks for listening.
Security Token Academy does not provide investment or legal advice. We are not a registered broker-dealer or investment advisor. Opinions expressed in this podcast are the speaker's own and do not necessarily reflect the views of Security Token Academy. More information can be found on our website at securitytokenacademy.com.